There is a silent killer out there that destroys thousands of incredibly successful, rapidly growing small businesses every single year. And the most terrifying part is that most business owners never see it coming until it is entirely too late. I'm talking about a financial paradox that catches even the most experienced entrepreneurs completely off guard. The reality that your business can actually go completely broke while experiencing its highest sales numbers ever. It sounds impossible on the surface, right? How can a business that is winning more clients, signing bigger contracts, and generating record-breaking revenue suddenly find itself on the brink of collapse? The answer lies in a structural phenomenon known as the cash flow dip. Today, we are pulling back the curtain on why growth requires massive amounts of cash, how the gap between operational expenses and client payments can quietly choke your operations, and exactly how a flexible business line of credit acts as the ultimate financial shield to keep your company alive while you scale. To understand why this happens, we have to look at the anatomy of business growth. When your business is small and steady, your income and your expenses usually maintain a predictable, manageable rhythm. You know exactly what is coming in, you know what is going out, and your capital requirements remain relatively flat. But the moment you decide to scale up, the moment you land that massive new corporate client, double your order volume, or expand into a brand new market, that predictable rhythm is completely shattered. Growth does not happen for free. To fulfill a massive new influx of business, you almost always have to spend a substantial amount of cash upfront. Think about the reality of expanding operations. You have to buy raw materials or double your inventory just to prepare for the orders. You might need to hire additional staff, pay for overtime, or bring on specialized contractors to handle the fulfillment. You might even have to purchase new equipment or upgrade your digital infrastructure to support the increased demand. All of these expenses require immediate cash layout. Your suppliers want their money now, your employees must be paid every single Friday, and your landlord isn't going to wait for rent. But here is where the trap snaps shut. While your expenses shoot straight up instantly, your actual revenue from that growth doesn't hit your bank account until much later. In the B2B world and in most commercial industries, clients don't pay up front. They demand net 30, net 60, or sometimes even net 90-day terms. This means you are completely on the hook for funding all the labor, materials, and overhead required to fulfill that massive new project for 1, 2, or 3 months before you see a single dime of profit from it. That massive, terrifying gap between the day the money leaves your account to fund the growth and the day the client finally pays your invoice is the cash flow dip. The faster your business grows, the deeper and wider that dip becomes. If you don't have a massive stockpile of working capital sitting idly in your reserves, your business can easily run out of cash right in the middle of fulfilling your biggest contract yet. You become asset-rich on paper with massive accounts receivable, but completely cash-poor in reality. And when you can't make payroll or pay your primary suppliers, your entire operation can completely lock up, forcing a thriving company to go under simply because of a timing mismatch. When business owners suddenly wake up and realize they are trapped in a severe cash flow dip, their first instinct is usually to run straight to their local traditional bank. But if you try to apply for a standard bank loan during a rapid growth phase, you are going to run into a massive brick wall. Traditional banks are fundamentally built on outdated, rigid underwriting guidelines that are entirely incompatible with the speed and unpredictability of modern small business growth. First of all, a traditional bank loan takes weeks, if not months, to get approved and funded. When you are in a cash flow dip, you don't have months to wait. You need capital within the next 48 hours to cover payroll or secure inventory. Second, traditional banks get completely spooked when they see a temporary dip in your operating cash or tighter margins on your recent financials, even if that dip is a direct result of smart, aggressive expansion. They look at your past tax returns or your current tight balances and see risk, completely failing to understand the massive, verified revenue that is locked up in your pending invoices. Worst of all, they will demand that you tie up your hard assets, your real estate, or your heavy equipment as collateral just to secure a basic loan, effectively slowing your business down even further with red tape. This is exactly why growing businesses need to step away from traditional banking structures and leverage performance-based, alternative financial tools, specifically an unsecured business line of credit. A line of credit is fundamentally different from a standard fixed-term loan, and it is uniquely engineered to solve the exact timing problem created by the cash flow dip. Think of a business line of credit as an open, revolving reservoir of capital that sits in the background of your business, ready for you to tap into at a moment's notice. You don't take out a massive lump sum of debt all at once and start paying interest on day one. Instead, you are approved for a maximum credit limit based on your real-time revenue and cash flow history. If you are approved for a $100,000 line of credit, that capital costs you absolutely nothing while it sits there. If your business is running smoothly and your cash flow is positive, you leave it untouched. But the exact moment you hit a cash flow dip, the moment you need to purchase $50,000 worth of bulk inventory to fulfill a surprise order, or you need to bridge a 2-week gap before a major client clears an invoice, you simply draw down the exact amount you need directly into your business checking account. The beauty of a revolving line of credit lies in its flexibility and efficiency. You only pay interest on the specific dollar amount you have actively drawn out, not the total approved limit. If you pull out $20,000 to cover an upcoming payroll cycle during a tight week, you only pay interest on that $20,000. Then, the moment your client finally pays their net terms invoice 30 days later, you take that incoming revenue and pay the $20,000 right back into your line of credit. The moment that balance is repaid, your available credit limit automatically restores back to the full amount. The capital is immediately ready for you to use again on the next project, the next contract, or the next seasonal dip. It creates a seamless, self-sustaining financial cycle that perfectly mirrors the natural ups and downs of a scaling business. Because this tool is performance-based, modern underwriters don't care about locking up your physical equipment or analyzing years of historic tax returns. They care about your current operational momentum. They look at your recent gross monthly bank deposits to verify that your business has consistent, healthy revenue flowing through its accounts. If your business is generating stable monthly revenue and has a proven track record over the last few months, your cash flow itself becomes the leverage needed to secure the line. This streamlined, data-driven approach allows approvals and funding to happen in as little as 24 to 48 hours, giving you the agility to make executive decisions at the true speed of the market. The absolute biggest mistake you can make as a business owner is waiting until your bank account is dangerously close to zero before trying to secure this financial safety net. When you are desperate for cash and your bank statements show severe distress, underwriting becomes significantly harder, and your terms won't be nearly as favorable. The ultimate strategy for smart, sustainable growth is to establish your business line of credit proactively. While your revenue is high, your statements look incredibly strong, and your momentum is undeniable. You want to build the well before you are thirsty. By securing a revolving line of credit during a high-revenue month, you lock in the highest possible credit limits and the best possible terms, ensuring that you have an invisible, powerful cash cushion completely locked and loaded long before the next cash flow dip even begins to form. Having this revolving capital instantly available completely changes how you operate as a CEO. It removes the fear and hesitation that holds so many entrepreneurs back from taking their companies to the next level. Instead of turning down massive new clients or passing on lucrative contracts because you are terrified you won't have the cash to fulfill them, you can confidently say yes to every single growth opportunity that comes your way. You can negotiate better volume discounts with your suppliers because you have the cash to pay them immediately, and you can comfortably offer net terms to major corporate clients, giving you a massive competitive advantage in your marketplace. If you are ready to stop playing defense with your cash flow and start building a real financial foundation that supports your scaling ambitions, it is time to take action. You don't have to navigate endless paperwork or deal with slow bank committees that don't understand your business. Click the link in the description right now. You can securely upload your recent business bank statements, completely bypass the traditional collateral requirements, and see exactly how large of a flexible line of credit your current revenue can unlock for your business. Protect your hard-earned growth momentum, eliminate the stress of the cash flow dip, and give your company the capital flexibility it deserves. Click the link in the description below today, and let's secure your business's future on your own terms.